Oliver, today we're going to talk about RWAs. This is a very complicated and little understood measure, both by professionals and amateurs alike. Risk-weighted assets. It's the way banks look at their balance sheets and assign different risk weightings to their various assets. Now, the RWA came out today with a report on them. What did they say?
Their report was just looking at differences in risk-weighted assets as reported by banks, and just trying to explain why banks would take an asset that looks the same, say a residential mortgage, but assign different levels of risk to it. And what the EBA found was that about half of the difference, there was a big difference, about 70% difference in the amount of risk that's assigned to it. They said about half of that is down to regulatory factors, what the regulators say they have to do with these assets, how they have to look at them. And half was due to something else. Now, the big question is, what is this something else? The bank bashers, the skeptics say this something else is the banks gaming their books. They're using their internal models to tweak it to make it look like they're less risky. The advantage of doing that is that if they're less risky, they have to hold less capital, which is more efficient for them to do.
And we should remind watchers here that this is important because it's the denominator of the capital adequacy ratios, the Basel 1, 2 and 3 ratios that you hear quoted quite a lot. And I guess the point is that the ratio is a single number, and if you can't trust the number, we won't know how risky the banks are.
This is it. If the banks are being too aggressive with their models and their risk-weighted assets too low, then by definition the capital they have to hold against that is too low. And the suspicion, the fear is if the banks then hit problems, they're not going to have enough capital to cope with it.
And I guess the interesting for us is we've gone and interviewed a lot of banks about RWAs, and a misconception is that they are actively fiddling these RWA weightings. That's not really the case, is it?
No, there's lots of reasons why RWAs for the same sort of asset class might be different between two different banks. For example, two banks might take very different attitudes towards collection of the debt. If a debt turns bad, one bank might say, well, let's leave them a little while, see if they can make it up. Another bank might say, we're going to aggressively go after this debt. That has different implications for the riskiness of their books and for how they measure the books and for how much capital they have to hold against it. So there can be very legitimate reasons why banks have a very different attitude to risk.
And assuming that this is the least worst option of measuring risk, are there any tweaks that are possible to this system to improve it?
There could be a lot of clarity. The big problem at the moment with the system is that a lot of people don't trust it. So you need to make it more trustworthy, a lot more clear. Reporting of it could be a lot better. Banks should have to explain if their risk weightings are very different from the average, why that's the case, and to work more closely with the regulators. There are lots of other systems, all of which have bigger drawbacks than this one, but a lot more clarity would certainly help.
It certainly would, and certainly for sure is that RWAs are here to stay, so thank you very much for that update.